Hey, welcome back, options traders. Good morning, everyone. Well, every trader needs to understand where profits and losses, for that matter, come from. Too many times traders say, well, I'm going to make money on a call if the stock price rises. All right, well, that's sort of true. But how much came from delta? How much comes from gamma? How much was lost due to theta? And if you don't know how to break these profits down, you could be left with very unwanted surprises. And even if it's a good surprise, such as higher than expected profits, you need to understand where they came from. Because if you don't understand where profits or losses come from, you're really trading blind. And that's no way to approach options trading. So let's look at a specific question and find out how much profit comes from gamma. Before we get started, as always, please be sure to click like and subscribe. It's greatly appreciated and helps so much to promote the channel. So, sources of profit. Again, traders must understand where profits come from. They're not only from changes in the stock's price. That's a stock trading mentality. Now, when you're trading, let's call them near the money options, something that's maybe not exactly at the money, might be a little in the money or a little out of the money, they can get a very big boost from gamma. And too many times traders completely ignore this or simply don't understand where it's coming from. And of course, the bigger surprise can come from the short options that are at the money with this big boost in gamma. So let's take a closer look and figure out the math behind how much profit comes from gamma. Well, there's some questions we need to answer. The first one is how much profit comes from delta? And that's pretty easy. It's going to be delta times the change in the stock's price. But then the trickier one is how much profit comes from gamma? And for this one, we need a little bit of a formula. I'll show you the intuition behind the formula in just a moment, but it's going to be this. We're going to take half of gamma and multiply it by the change in the stock price squared. Now, this only works for small changes in the stock's price, but we could stretch it a little bit and look for a $2 change, maybe a $3 change, and try to get a handle on how much profit is coming from delta and how much from gamma. So for example, let's say that a stock is trading for 100, our broker's platform shows the delta is 60, the gamma is 10, and the $100 call is trading for 3. Now we're going to assume that the stock price rises $1. All right, so how much of the profit comes from delta? Well, the previous formula said we take the change in the stock's price, which is $1 times delta. So we should see about 60 cents of an increase in our current options price coming from delta. Now the formula also said to take half of gamma, so if we take half of gamma, that would be 0.05, times the change in the stock's price squared. Of course, 1 squared is still 1. So we're just taking 0.10 divided by 2 times 1 is 0.05. So that tells us that the $100 call is going to gain 60 plus 5, or about 65 cents. 60 cents is coming from delta, and a relatively small amount is coming from gamma. But as you're going to find out in a moment when we do some more detailed examples, the amount from gamma can quickly overwhelm the amount from delta. So here's a little bit of the intuition behind the formula and why we need to take half of gamma. Let's say that we have a delta of 60, that was the last example, and now we're going to assume that the stock increases by $1. Well, we also know that gamma was 0.10, and that tells us that the delta is going to increase over this $1 range from 60 to 70. But notice that that doesn't mean you're at delta 70 the entire $1 change. You're also not at delta 60. Where are you on average? On average, you're at delta 65. So we can see now that 60 deltas right here is being accounted for, but also the additional 5. It's half of gamma. And so that's another way to understand where we got 65 cents from. So let's take a look at some more practical examples by going to a Black-Scholes pricing model. Let's say that we have the stock at 100, the strike at 100. We'll give it 10 days to expiration so we get a lot of gamma, volatility of 20%, and it's telling us that the call should be priced at $1.32. Now let's assume that the stock rises $1. All right, so what did the formula tell us? Well, we know we've got a delta of 50. And so if we pick up a dollar times a delta of 50, that should give us at least 50 cents. And this is what most traders will use for their calculations. They'll say, okay, that option's going to pick up 50 cents. Well, but we have to account for gamma, especially because it's pretty big relative to delta. It's about 1/4 the size. So the formula said to take half of gamma times the change in the stock's price squared. Now, of course, 1 squared is 1, so we could just forget about this. We're taking 0.12 divided by 2, or about 6 cents. Now, in this case, it's not making a huge difference in the addition to our options profit. But in total, we should expect to pick up about 56 cents. So if we add 56 cents to $1.32, we should expect this call option to increase to $1.88. So let's increase the stock over here from 100 to 101, and there we go. There's $1.88. All right, let's go back to the beginning with the stock at 100. Let's now assume that the stock rises $2. The formula said we should take a change in the stock's price of 2 times our delta of 50. That's going to account for at least $1 in our options price change. So how much is going to come from gamma? Well, we know that gamma is 0.12, so 0.12 divided by 2, but now we have to multiply by the change in the stock's price squared, which is 4. 2 squared is 4. So we're starting to accelerate our deltas by gamma. So if we take 0.12 divided by 2 is 0.06 times 4 is 24 cents. See, now gamma is starting to account for a larger percent of our profits. We should expect this option to pick up $1.24, not the dollar that most traders would assume by just looking at delta. So if we take $1.24 plus $1.32, that's going to give us about $2.56. So if we change the stock's price from 100 to 102, we should get roughly $2.56. Let's try it. There's 102 and there's $2.56. All right, let's try one more. Let's go back to the beginning. Stock is 100, and let's say that the stock rises 3 points now, or maybe that's what our expectation is. We're trying to stress test our position and saying what would happen to this value. Well, we know that $3 times delta would give us $1.50 minimum, but we also have to account for gamma. So let's take 0.12 divided by 2 times the change in the stock's price squared, so that's 9. Now we're going to take 0.06 times 9 is now 54 cents. So now we're starting to see that gamma is contributing a much bigger proportion of these profits than we had initially thought. So if we take $1.50 plus 54 cents is 204, added to our current options price of $1.32, should give us about 336. And if we change the stock's price from 100 to 103, let's see if we get 336. See, now we're starting to overshoot it a little bit. And what's happening now is we're seeing that our gamma curve is changing. Gamma doesn't stay at 0.12 like when the stock was at 100. So this is why you have to be careful about using these formulas over broad ranges. But again, for fairly small ranges, let's call it $1 or $2, maybe $3, you can at least get some pretty good insights into how your options price will change. But part of the thing to understand is you cannot overlook the effect of gamma. So remember, when we're talking about risk, not knowing where profits come from is just as bad as not understanding where losses come from. You must be able to account for losses, but also for the profits. Successful traders always know the sources of profits. Now, this is especially important for stock splits, which I've talked about in previous videos. Remember, for stock splits, gamma increases by the square of the split. So for the last Apple split, for instance, when it was a 7-for-1 split, your gamma increased by 7 squared, or 49-fold. So if you're not accounting for gamma, hopefully this video shows why it can create unexpected losses as well as unexpected gains. And you need to know where those gains and losses are coming from. Otherwise, you're just guessing at how your options are going to perform, and that's never going to give you good results. And for anyone who'd like to learn more about the art and science of options trading, please check out the Alpha Trader course, Strategy Lab, and a brand new candlesticks and technical analysis course. It's all at optionsatoz.com. Also, please join us on Options A to Z's Facebook trading group, and you can find a link in the description below.